Do you have a whole life policy and are you looking to borrow money? Well, today we're going to talk about how to borrow money from a whole life policy and the pros and cons behind it. My name is Stephen Sinclair from Dundas Life, and if you like our content, feel free to smash that like button and hit subscribe for more information about life insurance. So let's talk about borrowing from a permanent policy, such as a whole life policy or a universal life policy. Whole life or universal life policies are permanent policies that have the added feature of an investment component, or what we call a cash surrender value. This cash surrender value is typically paid through the premiums, as you pay it monthly or annually, and compounds over time tax deferred. So later on in life, you can then utilize that money in different ways. And one of those ways is by borrowing from that cash surrender value. Now, what's the benefit to borrowing from your policy? Well, if you've had the policy for quite some time, you probably have a fairly large amount of cash value built up over those years. You can borrow up to 90% of your policy's cash value without having to forfeit your policy, so you can still keep the policy in place. The benefit to borrowing is that your cash surrender value is actually not touched. You're borrowing from the insurance company, so the cash surrender value continues to compound over time, still tax deferred. The other benefit to borrowing is that you don't have to go through the lengthy process of getting approved for a loan. You can just fill out a few forms with the life insurance company and borrow that money right away, use it for whatever you'd like. The other benefit is that the interest rate is typically lower than what you see with something like a credit card. Interest rates are usually around 6 to on a high end 8%, 9%, 10% with borrowing from your cash surrender value. Now, why would you not want to do this? Well, if you're borrowing from cash surrender value, keep in mind, you're gonna have to pay that money back, either while you're alive or when you pass away. While you're alive, you're gonna have to pay interest on that. Now, let's say, for example, that you couldn't pay that money back during that time frame, and that interest is still compounding on your loan. Well, if that exceeds the amount of the cash value, you're going to be on the hook for not only your policy, as it's going to have to be forfeited, but the thousands of dollars that you've borrowed as well, which could put you into a really precarious situation. The other time when it might not be good to borrow is that ultimately this money and the death benefit is meant for your family. If you can't pay that back and you pass away, your family is going to get less of that death benefit because the insurance company is going to take from that first. So if you're considering borrowing from your policy, consider that, yes, there are some advantages, but only do it if you really need to, because at the end of the day, you're going to have to pay it back while you're alive or when you pass, and that's eventually going to affect your family's death benefit as well. So hopefully this answers some questions around borrowing from your whole life policy or from your universal life policy. If you have more questions, reach out to a Dundas Life advisor, and have a great day.